Imagine for a second that you have a superpower. You can float above the earth, and instead of seeing weather patterns, you can see money, where it's flowing, where it's pooling up.
That would be a significantly more profitable superpower than, say, flying.
Ideally, yeah. But here's the thing, you don't actually need superpowers. You just need to look at the portfolio of Blackstone. It is Thursday, January 29, 2026, and the world's largest alternative asset manager just dropped their Q4 2025 earnings. And, I wouldn't usually drag you through an earnings call.
But this one matters.
This one matters.
It's the scale. We're talking about nearly $1.3 trillion in assets under management. It's larger than the GDP of entire countries like Saudi Arabia or the Netherlands.
Right. So when you control that much capital, you're not just an investor. You are a massive data gathering engine.
Exactly.
And that's really our mission for this deep dive. We're going to treat this report like a decoder rim for the global economy. We want to know what the smart money sees coming, especially with AI, private lending, and, well, why they're buying real estate when everyone else is terrified of it.
And we have to start by setting the scene because the context here is, it's weird. If you've been reading the headline, the economic vibes are not exactly champagne and caviar.
No, it feels more like mud and uncertainty.
Yeah, we have tariff wars heating up, geopolitical instability. We're just shaking off that government shutdown. The Federal Reserve even compared this whole backdrop to driving in a fog.
Which usually means slow down.
Exactly. You tap the brakes. But, and this is the contradiction we need to unravel, in the middle of this fog, Blackstone just posted its best results in its 40-year history.
Okay, hold on.
Anyway.
That just doesn't make intuitive sense. If the macro environment is so messy, how are they printing record numbers? Let's get the actual stats.
Fair enough. The headline number is distributable earnings. Think of it as the actual cash profit they can hand back to shareholders. That hit a record $1.75 per share.
Okay, a record. But what about the new money? The inflows.
That's where it gets really interesting. In just the fourth quarter of 2025, so 3 months, investors handed Blackstone $71 billion in new capital.
$71 billion in 90 days.
And for the full year, it was around $240 billion. So despite the fog, despite everything, capital is just flooding into these alternative assets.
So they have the money. The big question is, what are they doing with it? And this brings us to a phrase their president, John Gray, used. He said, the deal environment has finally reached escape velocity.
That is a very deliberate choice of words. It implies you're breaking free from some kind of gravitational pull.
But the gravity of what? What was holding them down?
The gravity of high interest rates, think back to 23, 24, the deal market buying companies, selling companies. It was basically frozen, hibernating.
Because borrowing money was just too expensive.
The math didn't work, so everyone just sat on their hands. Gray is saying right now, early 2026 is like the 2013-2014 period. The ice is cracking.
Okay, so the rocket is taking off. Where is it headed? Because it looks like there's a massive land grab happening in one specific sector.
AI. But probably not the AI investing you see on your Twitter feed.
Right, they're not just buying shares of the latest chatbot.
No, that's a gambler's game. They're playing the picks and shovels game. They see that AI isn't just code, it's calories. It needs massive amounts of energy and physical space.
So they're pouring money into data centers,
Yeah.
power generation, all that physical infrastructure.
The backbone. I saw a number in the footnotes. They invested $138 billion in 2025 alone.
$138 billion.
Yeah. And their QTS data center business was the top driver of returns for their entire infrastructure strategy. They are literally building the physical shell that the digital economy lives in.
But they aren't just building it for others, are they? They said something about their own operations.
Oh yeah, the dog fooding aspect. If you're going to bet that kind of money on a technology, you better be using it. They said their own software engineers are becoming twice as efficient with AI tools.
Twice as efficient.
Yeah.
That is a massive productivity gain.
It is, and they have 270 portfolio companies. They're using AI for cyber monitoring, data summarization. I mean, imagine having a dashboard summarizing real-time data from 270 major companies.
It's basically a cheat code for the economy.
Precisely.
Now, part of escape velocity means the exit markets are open too. And we saw a huge signal flare there with Medline.
Wait, ITO, right?
Yes, the largest sponsor-backed IPO in history. Sponsor-backed just means it was owned by private equity firms like them. A $7.2 billion listing.
So how did the market react? That's a huge deal to bring to a nervous market.
The shares traded up 40% on day one.
Up 40% on a $7 billion deal.
Yeah.
Wow. That tells you the market is starving for quality. The hibernation is definitely over.
So the deal machine is running hot, but I want to pivot to something that sounds a little more rustic.
I have a feeling I know where you're going with this.
The farm-to-table credit boom. I have to admit, when I saw a Wall Street titan using that phrase, I laughed a little.
It sounds like they're selling heirloom tomatoes, not loans. But the analogy, it actually holds up if you break down how banking usually works.
Okay, unpack it for me. Why is the old way the processed food version?
In the traditional world, a company needs a loan, they go to a bank, the bank makes the loan, then they slice it up, package it, securitize it, sell it to another bank who sells it to a fund.
And every single hand that touches it takes a fee.
Exactly. It's all friction and cost, Blackstone is saying. We have the money from our insurance clients, and we have the borrower. Let's just connect them directly.
Farm to table, no middleman.
And the scale of this farm is now $520 billion in credit assets. The part that's really exploding is investment-grade private credit, up 30% year over year.
So why do the insurance companies love this so much?
It comes down to spreads. A spread is basically the extra interest you get for taking on risk compared to a super safe government bond. Right now, in the public bond market, those spreads are the tightest they've been since 1998.
So if I'm an insurance company buying regular corporate bonds, I'm getting paid almost nothing for the risk I'm taking.
You're getting very little juice for the squeeze. But by going farm to table with Blackstone, these clients earned an extra 180 basis points of spread last year.
An extra 1.8%. In the world of boring bonds, that's massive.
It's the difference between a pension fund being solvent or underfunded. That's why the money is moving.
But I have to play the cynic. We keep seeing these headlines about hidden risks in private credit. Is this just a bubble waiting to pop?
It's the most common criticism, where are the bodies buried? And they addressed it directly. They pointed to the data in their portfolio.
What's the damage report?
Over the last 12 months, their realized losses were just 11 basis points.
So 0.11%.
That's effectively zero. And the health of the companies they're lending to, their core earnings, are growing in the high single digits. So the borrowers are healthy, the losses are tiny, and the investors get a premium. It's hard to make the bubble argument stick with that math.
Okay, so credit is booming, AI is booming. But we have to talk about the elephant in the room. Real estate.
The laggard.
To put it mildly. I mean, the S&P 500 is up, 75% over the last 4 years. Private real estate values are down about 16%. So why is Blackstone deploying over $50 billion into real estate right now?
This is classic contrarian investing. You buy when there's blood in the streets. They believe the cycle is bottoming out, but their confidence comes from a very specific place, the supply side.
Let's drill into that, because we usually focus on demand, right? Who needs an apartment or a warehouse?
Exactly. But the story here is about what is not happening. Look at new construction starts in the U.S. for logistics and multifamily housing. They've fallen to the lowest levels in over 12 years. Developers just couldn't make the math work. High interest rates made construction loans crazy expensive. Inflation made materials expensive, so they just stopped building.
So no new supply is coming online.
Yeah.
But people are still having kids and buying stuff.
Precisely. Demand is steady, but supply just fell off a cliff. When you have steady demand and shrinking supply, what has to happen to prices and rents?
They have to go up.
That is the bet. They're looking past the current dip and seeing a massive supply crunch on the horizon.
And they're not just buying anything, right? They're not buying empty office towers.
No, they were very clear about that. 75% of their equity portfolio is in logistics, rental housing, and data centers.
Wait, data centers count as real estate?
In their world, yes. It's a building that bridges the AI boom and the real estate portfolio.
They also mentioned a specific deal privatizing Alexander and Baldwin.
A perfect example. They own grocery-anchored shopping centers in Hawaii.
Hawaii. Talk about a market with barriers to entry.
You literally cannot build more land there. It's the ultimate supply-constrained market. And grocery-anchored means it's recession-resistant. It fits their theme perfectly.
So we have the big institutions pouring money in. But there was another group that seems to be a huge engine for them now, the wealth channel.
The individual investor. High net worth versions of you and me, maybe?
Right. This is the democratization of alternative assets.
Yeah.
For a long time, you had to be a pension system and write a $50 million check. That is clearly changing.
The growth numbers here are wild. Fundraising from private wealth was up 53% year over year. That's $43 billion in 2025 alone from individuals.
And they estimate they have a 50% market share of all private wealth revenue across the major firms. They're just dominating this lane.
Completely.
But what about the products themselves? I remember a lot of scary headlines about Bright, their real estate fund, a year or two ago. People are trying to pull money out.
Yeah, there was a lot of panic during the rate hikes. But look at the performance now that the dust has settled. Bright returned 8.1% net in 2025.
And how does that compare to just buying a public real estate ETF?
It was nearly triple the return of the public index.
Triple. Okay, that explains why the money is staying put.
And BCRE, their credit fund, raised another $3.3 billion just in Q4, so the capital's flowing back in. But here's the thing. There's an even bigger catalyst on the horizon.
You're talking about the 401k market.
Yes, the Department of Labor rules. There's a potential shift coming that would allow 401k plans to include these kinds of alternative assets.
That feels like a massive change. Right now, my 401k is just index funds.
Blackstone called 2026 a foundational year for this. I mean, think about it. There are trillions of dollars in 401ks. If the gates open and even a small piece of that moves into private assets,
It's a fire hose of capital.
it's the holy grail, and they want to be the farm-to-table provider for your retirement account.
So let's zoom out. It feels like there are three very distinct engines firing for them right now.
I think that's right. First, you have the deal environment reaching that escape velocity. The freeze is over.
Engine one.
Second, you have the AI revolution, which is driving this massive physical build-out of data centers and power.
Engine two.
And third is this deepening adoption of private markets by individuals, unlocking a completely new tier of capital.
And sitting underneath all of that is what they call dry powder. They have nearly $200 billion in cash ready to be deployed.
That's their war chest. When you have that much cash just as the market is waking up, you can move faster and bigger than anyone.
It's a powerful position. But I want to leave you with one final thought.
Go for it.
There's a collision of two trends we talked about that I think defines the next 5 years.
The real estate supply shock and the AI demand shock.
Exactly. Walk me through that collision.
On one hand, we established that construction has basically stopped. We're not building new power grids, warehouses, or housing nearly fast enough. Supply is flatlining.
Right. The cranes have stopped spinning.
On the other hand, AI is the biggest demand shock in history. It needs more power, more data centers, more logistics than anything we have ever seen before.
So you have a world that has stopped building, colliding with a technology that needs everything built immediately.
And if that holds true, what happens to the value of the assets that already exist? If you own the power grid, the land, the warehouses, and the data centers right now, you are sitting on something that is becoming incredibly scarce, right as everyone needs it most.
That's a fascinating way to frame it. It's not just about a stock going up. It's about owning the physical backbone of the future when no one else is building it.
And that's how they can look through the fog and feel pretty confident about where they're going.
Well, we will certainly be keeping an eye on whether that fog clears up. For now, thanks for taking this deep dive with us.
Always a pleasure.
And to our listener, thanks for tuning in. We'll catch you on the next one.